Okay, and welcome class. This is today's recording is for last week. We did not have class. Class was canceled due to unforeseen circumstances. However, I still wanted to make sure that everyone received the course material. So, in last week's session, we were going to be talking about and discussing types of income. So, one of the important things about taxation is that most taxpayers, many taxpayers at least, don't really understand the types of income and why certain types of income have to be reported and taxes have to be paid on that income. So, in addition to discussing earned versus earned income, we're also going to talk about the types of income that's taxable versus those types of incomes that are not taxable. So I hope you find this session helpful. I encourage you to comment, leave comments, subscribe to our YouTube channel, and post questions or ask questions, present questions in the comments for things that will be helpful and topics that I can go into more detail about that will help you better understand income and the types of income that affect you as individual taxpayers. So moving right along, we're going to go over the lesson's objectives. And as I previously stated, we're going to be defining and differentiating the types of income. I'm going to explain some of the tax implications of different sources of income for you. We're going to identify taxable versus non taxable income. We're going to have some examples of each of these situations. I'm sorry, I'm getting ahead of myself, you guys. And yeah, so then we'll move on to our next slide. So as we move into earned versus unearned income, just to explain so that everybody understands, earned income. So earned income is one of those things that I think some people misunderstand, and I'll give you the biggest misunderstanding, and it's an understatement, which is what I was trying to say, as it relates to taxes, is many taxpayers don't understand that in order to qualify for the earned income credit, you must have earned income. Boom. I'm going to leave that right there for a second, and we're going to move on to what types, what constitutes earned income. So money received from active work, okay? Um Social services assistance payments, that is not active work. Okay? So active work is salary, wages, tips, commissions, and things like that. Versus unearned income. And unearned income is money that's received where there's no active work going on. There's no type of employment, W-2 employment, such as investment income, rental, rental income if you are a landlord. Pensions, if you receive 1099Rs, those payments are considered unearned income. You already worked for it, now you're receiving the pension. And things like inheritance. So now let's talk about taxable income and as it relates to income that's subject to things like wages, business income, capital gains, and rental income. All of those types of incomes are subject to taxes. Okay, so you can't, you know, if you are employed by a company, a business, an individual, even if you're self-employed, you are expected to pay taxes. You're expected to contribute your federal and your state and any other type of, whether it's local or municipality taxes. The expectation is that you will contribute to that system. Um, Non-taxable income is different in that non-taxable income is income that's not taxed, like gifts, life insurance payments, municipal bond interest, scholarships in certain instances. So you have to be careful about the types of of scholarships that may be applicable, or or have tax implications. Um, the big thing here, I think, will be life insurance payments. So if you are the beneficiary of a life insurance, in general, that is not taxable income to you. Okay. So again, we're gonna go over, sources of earned income. As previously stated, salary and wages, that's earned income. Bonuses and commissions, those are types of earned income. Self-employment income. Um, if you are an entrepreneur, or you are a sole proprietor, the expectation is that on a quarterly basis, at a minimum, that you remit your self-employment taxes. Um, the requirement for certain states may be different, but in general, you have to do reporting as well as remittances of those taxes. So you pay your estimated quarterly taxes on what you estimate or anticipate that quarter, that upcoming quarter's income to be. It may be that you don't generate income. And in that instance, when you do your reporting, you would say zero wages were earned during that quarter. So no tax remittance would be expected. But at least you have done the reporting that is required. Tips and overtime pay, those are types of earned income. A lot of people don't understand that if you are um, doing gig work like waitressing or bartending or anything, parking attendants, anything where you receive tips. Tips kind of go along with the honor system, right? So we know that a lot of people, may not agree with or prescribe to the fact that you have to, or you're supposed to report tip income. So they don't. But reporting tip income does help you in the aspect of when you report that income goes into your calculation for your Social Security benefits. So, yeah, with everything going on in the world and in the economy today, it's a toss up. So, I ain't gonna tell y'all what to do with y'all's business about that. I'm just gonna say it kind of works. It's kind of like an honors thing. It's an honors system, one of those types of things. So, those are the major, most common, most prominent sources of earned income. And let's see. We're going to go to the our next slide where we talk about sources of unearned income. So, unearned income. All of us at some point in time, if we don't now, we've had bank accounts, credit union accounts where you earn interest and dividends. So, interest and dividends are sources of unearned income. So are capital gains, and capital gains are the result of buying and selling stocks and investments. So if your broker or your financial manager is managing an account where you have stocks and mutual investments and things like that, there, the stock market goes all the time. So there are trades that are going on when we are asleep. If you are, if they are selling or purchasing investments on your behalf, depending on the basis or the cost that they're purchasing those investments for, versus the proceeds for any of your investments that are being sold off. Whether it's a gain on that sale or a loss on that sale, at the end of the day, it's going to constitute either a capital gain or a capital loss. If it's a capital gain, that gets included in your total income calculation when you file your taxes. If it's a capital loss, that loss also gets accounted for as your total income, but a loss would actually reduce your total income. Okay? So then there's rental income. This is another source of unearned income. So if you are a landlord and you have rental properties, whether they are actively managed by you or whether they are passively managed by a management company or whether they are a part of the Section 8 program, you are a a property owner and you are a landlord. So any rental income that is received, you would file that on your taxes on a Schedule E, rents and royalties, and that becomes taxable income. Social Security benefits, that is a source of unearned income. And depending on the amount of Social Security benefits that you received, upwards of $25,000 would determine whether or not your Social Security benefits are taxable. So that really becomes important if you are a Social Security benefit recipient and you also receive a retirement or a pension from having worked and retired from an organization or a company. So when you look at the total combined types of income, whether or not your Social Security benefits will be taxed or not is dependent on those factors. Also, if you are married and you file taxes jointly with your significant other, spouse or significant other, that also could be a factor, if especially if that individual receives works or whether they receive Social Security benefits as well, or if they are receiving some type of retirement or pension compensation as well. So there are a lot of factors. There are some factors that will go into whether or not your Social Security benefits are taxable. But in general, the rule is, in general, the rule is that Social Security benefits are not taxed. That is not always the end result, but for most Americans, that may be true. And the last source of unearned income that we'll cover um, right now for this class is pensions and retirement withdrawals. So anytime you withdraw from your 401k or any other type of pension system or retirement um, account, it, there are a few things that actually would be applicable, taxes being one of them. But if you withdraw from any of those types of programs and you're not at least age 59 and a half, you're not only going to get hit with the tax ramifications of it, but you're also going to get hit with a early withdrawal penalty. So the whole goal is that when you have a retirement account set up, you utilize it and you withdraw from it when you are retirement age. And retirement age for federal government purposes is at age 59 and a half. So any withdrawals prior to that age time frame, then you would be subject to a penalty. There are some exceptions, and those exceptions would be applicable and factored in if you are withdrawn from the system to fund your education or a dependent or family member's education. If you are trying to prevent a foreclosure on your primary home, there are some things that you can, or if you have a federal tax debt that you're wanting to pay off, there are some ways that you can withdraw from your retirement accounts and not be subject to the neither the tax or the early withdrawal penalty. So it's best that you speak with your investment manager or your tax accountant in order to get more information about how those types of withdrawals will affect you. And again, we're going to talk about tax implications of the different income sources. So for earned income, as we all know, is subject to payroll taxes, Social Security, Medicare, so on and so forth. The big one being federal and state taxes if you live in a state where there is a state tax structure. No getting around that. Also, investment income, maybe tax at a capital gains rate. So capital gains rate, generally, it could be, capital gains most of the time is not most of the time. Capital gains are dependent on, your investments as it relates to whether they are short term or long term investments. So if you have a capital gain and it's based on short term, investments that you have, or, short term properties and collaterals, then that's based on generally your ordinary tax bracket or your ordinary tax structure. But capital gains on long-term investments are generally it's going to be either zero or somewhere around 12%, maybe 15% depending, but they usually fall in those two categories, 0 or 12%. So just be mindful of that as well. Rental income is taxable, but you are allowed deductions when it comes to rental income. So just be mindful. And I have this a lot with a lot of my business clients, or at least starting out. I kind of have my core group kind of trained now. They know I've been able to teach them how it works. But with rental income, it is taxable, but you are allowed deductions. So, for instance, if you own rental property, again, whether it is actively managed by you or passively managed by you, there are certain things that you are allowed to deduct. For example, if you own a home and that home is being used as rental property, you can deduct homeowners insurance. And most programs, for example, Section 8 or public assistance programs, they require you to have insurance, homeowners insurance and things like that. That covers and protects you as well as any renters that they may place in your establishment. So, homeowners insurance. If you have to, you know, fix a door, replace a door, replace the blinds or paint, upkeep and things like that, you are allowed to deduct those expenses. So those expenses and those deductions would actually reduce the amount of rental income proceeds that you actually realized. So in doing so, I'll give you an example. If you had $20,000 in rental income for a property that you have renters in, and you had to replace the HVAC system, that's going to could run anywhere from 6,000 to $10,000. So let's just say, you had to replace the HVAC, it was $6,000. So of that $20,000, only 14 of that would be considered taxable because you would be allowed to reduce that rental income by the amount that of expense for that HVAC system. So let's just say it was an HVAC system. You had to replace some plumbing. So the HVAC was 6. You had to replace plumbing. That was 2. So now we're at 8,000 in deductions. And let's say you pay for lawn maintenance and all of that. That's 1,000. That's $9,000. And let's say something else, it could be another type of upkeep. You had to do some repairs to the roof, so that was another 1,000. So that's 6, another 2, another 1, and another 1. That's $10,000. So of that $20,000, only 10,000, not only half of that rental income is now taxable to you. Okay, so just keep that in mind. And as taxpayers, don't forget that your goal should be to maximize as much as reasonably possible your deductions that you are eligible to take. And I think that sometimes in the daily hustle and bustle of living life, that a lot of taxpayers miss that opportunity to do that. Now, there are some taxpayers on the flip side that try to write everything, including the sheetrock, off the walls, but and that's okay as long as it's valid and as long as you can prove, those expenses. So, it's 6 on one hand, half a dozen on the other. My purpose here is to educate and to teach you the different um, things that I think as taxpayers we should all know and familiarize ourselves with. So we're going to move to certain other unearned income, life insurance payouts. Like I stated to you previously, life insurance payouts are not taxable. So that's not considered taxable income. Therefore, you should not be reporting that or have or be expected to report that on your taxes. And so finally, our session is going to be a summary for our summary to summarize our session for today. Earned income comes from active work. Remember that unincome, unearned income, excuse me, comes from passive sources. So passive sources such as being a renter or being a landlord. Taxable income includes most earnings, while some sources are not taxable. So when we talk about taxable income, we're talking about just about everything you can think of in its totality, okay, as being taxable income. So the expectation should be that you acknowledge up front, if I do this, whether it's gig work or whether I'm working a W-2, a real job over here, that I am expected to pay some type of taxes on that income. I am expected to have deductions withheld from my W-2 earnings, and I'm expected to remit taxes on any type of self-employment income. Okay, y'all, I'm telling y'all, the bros get to acting up. They know what's gonna happen. And finally, understanding the tax implications, that helps you with financial planning. So again, like I said, if you have any questions and you have investment management um, assistance, I encourage you to utilize those individuals. They receive a management check. And they get paid to manage your investment portfolio. You should, by all means, be able to pick up the phone and call them, ask questions, get if you don't understand it, ask them, hey, I don't understand that, can you please explain that better for me? Can you, even talking about, in tax planning and financial planning strategies, there may be an opportunity for you to have conversations with your financial manager about which long-term investments they're selling off, and there may be an opportunity for you to defer capital gains from the current period to a future period where your income may be higher and you can better absorb those capital gains that you may receive. So that's it for today's session. I hope you found this helpful. I ask that you please drop comments, ask questions, and give me some topics on some future things that may not be in my lesson planning for individual taxation 101, but questions that you personally may have, and it may be something that may help someone else. Please don't forget to subscribe to our YouTube channel. It's just me, Dr. T, on YouTube. You can also follow me on TikTok, Dr. Tanya. Also, it's just me, Dr. T. And you please can go to my website at tsjfinancial.com, subscribe to our newsletter, and join us. Help us build this community where we're building knowledge and that we are converting this knowledge to power, because these are topics that we all need to grow from and better understand as we move forward in our lives. I wish you the best and hope that you enjoyed this session. Have a great evening.